Target just told the world its profits doubled this quarter.
Yeah, that's quite the headline to wake up to.
Right. And I mean, the stock market is predictably thrilled about it, but if you actually read the fine print, you quickly realize that nearly half of that so-called profit came from a single massive refund check mailed by the U.S. government.
It creates this fascinating distortion field. I mean,
Yeah.
you read a headline about doubling profits, and your immediate assumption is just, operational dominance.
Yeah, you assume they're just crushing it.
Exactly. You assume they're moving twice as much inventory, or their margins have structurally improved. But an accounting event paints a very, very different picture.
So today we are taking a deep dive into an equity research report on Target's second quarter 2026 performance. Our mission here is to kind of strip away the headline hype, examine the underlying cash flows, and see how the market is pricing in what looks like a flawless quarter.
Right, because things are rarely flawless when you look under the hood.
Exactly. By the end of this analysis, you are going to have a framework for spotting the difference between a temporary financial windfall and actual sustainable business growth. So let's start with the visible data because, the initial market reaction is always driven by the headline.
Right, the flashy numbers.
Yeah, Target beat estimates. They reported an earnings per share of $4.11 on $26.54 billion in revenue for Q2.
Which is huge. We really need to put that $26.54 billion into perspective.
Go for it.
Well, in the previous quarter, Q1, they did roughly $25.4 billion.
Okay, so a nice jump.
Yeah, that was a 6.7% year-over-year growth rate. And for the full fiscal year of 2025, we're looking at nearly $105 billion in total revenue.
Man, $105 billion, that is just a staggering amount of money.
Right. I mean, operating at that scale, moving tens of billions of dollars of physical goods every 90 days, it requires a massive logistical engine.
Yeah.
So posting sequential growth on top of those numbers gives the immediate impression of just absolute strength.
It sounds incredibly healthy until we look at the source of that profit surge.
Yeah, here's where the asterisk comes in.
Right. The research notes point out that while Q2 profits supposedly doubled, that figure includes a $752 million benefit from IEEPA tariff refunds.
That's a huge chunk of change.
It is. Furthermore, Target raised its full-year earnings guidance to a range of 9.9 to 10.90 per share. But $1.65 of that full-year projection comes strictly from these tariff refunds.
Yeah, that's definitely masking some things.
So help us understand the mechanics here. What exactly is an IEEPA tariff refund, and why on earth is it showing up in their quarterly profits?
Right. Okay, so the IEEPA is the International Emergency Economic Powers Act.
That's intense.
It is, kind of. It essentially allows the federal government to regulate commerce and levy tariffs during national emergencies.
Okay.
When a retailer imports goods, say electronics or apparel, they pay those tariffs at the port. It's just a cost of doing business.
It's like a toll booth.
It's exactly like a toll booth. But these tariffs are often legally contested or, they're subject to these really long review processes.
Oh, I see where this is going.
Yeah. So if the government or the courts eventually decide those tariffs were improperly collected or should be reversed, the retailer gets a refund. Target just got a check for $752 million for tariffs they previously paid.
Wow. And how does that work on the books?
Well, from an accounting perspective, that money flows straight to the bottom line as net income. It counts as profit.
Even though they didn't actually sell anything to get it.
Exactly. Mechanically, it has absolutely nothing to do with their current ability to sell merchandise.
It's essentially a retroactive clerical event.
That's a perfect way to put it, yeah.
Let's frame this with a grounded analogy. It is like an employee bragging that their monthly salary just doubled.
Right.
You assume they got a huge promotion or closed a massive deal, but then you find out they simply received a one-time tax refund check from the IRS and just deposited it in the same month as their normal paycheck.
And if you extrapolate that individual's future spending power based on that single month, you're going to miscalculate their financial health entirely.
Yeah, you can't buy a boat just because of a tax return.
Right. They cannot afford a more expensive mortgage just because the IRS sent them a backdated check. Yet, that is exactly the risk the stock market is running right now with Target.
So if the stock market is valuing the company based on this inflated guidance, what does the underlying operational reality actually look like?
It's definitely less glamorous.
Because if we remove that $1.65 per share benefit from the projection, the actual operational earnings power is suddenly significantly lower. Does this create a setup where next year's comparisons are going to be practically impossible to beat?
Absolutely. Wall Street, they operate on year-over-year comparisons.
Right.
Next year, Target will not have a magic $752 million government check to pad their bottom line,
Unless they get really lucky again.
which is highly unlikely. They will have to generate that profit purely through operations. And when you look at the operational metrics, there's real margin pressure there.
What do the margins look like right now?
Well, the trailing 12-month gross margin is sitting at 28.14%, but the net margin, what they actually keep after all expenses, is a razor-thin 3.24%.
Oh, wow. 3%.
Yeah. Retail is a game of pennies. Masking that fundamental reality with a one-time windfall is dangerous.
Okay, so if the earnings headline is an illusion of profit, we have to bypass the income statement entirely, right? And look at the balance sheet.
You always have to look at the balance sheet.
We need to evaluate the foundational health of the company without the refund.
Right. When you want the ground truth of a business, you look at the cash.
Show me the money.
Exactly. And to be fair, Target's cash position is objectively solid, rising to $3.5 billion as of early May 2026.
Okay, $3.5 billion. That sounds like a comfortable cushion.
However, that cash is balanced against a substantial long-term debt load of approximately $14.4 billion.
Oh, $3.5 billion in cash against $14.4 billion in debt.
Yeah, the ratio isn't great.
Especially in a high interest rate environment. Carrying that much debt has to be expensive. But let's look at how cash is actually moving in and out of the operation. The operating cash flow jumped to $716 million in Q1.
Which is a good number on the surface.
Right. Yet their capital expenditures, the money spent on physical assets, was over $1 billion.
Yeah, that's where the math gets tricky. If you subtract the $1.035 billion in capital expenditures from the $716 million in operating cash flow, you arrive at what analysts call a free cash flow proxy.
And what was that proxy for Target?
For Target in Q1, that proxy was negative $319 million.
Negative $319 million, meaning more cash went out the door than came in from actual operations.
Exactly.
Why is the capital expenditure so aggressively high? I mean, what are they spending $1 billion a quarter on?
Well, a lot of it goes into maintaining the specific aesthetic and logistical demands of modern retail. Like remodeling. Yeah, they are constantly remodeling stores, but not just to look good. They're actually retrofitting them to act as micro-fulfillment centers for online orders.
Oh, that makes sense. Ship from store.
Right. Plus, they are updating supply chains and investing in brand partnerships. However, it is vital to acknowledge the seasonality of retail here.
Fair point.
A negative free cash flow proxy in Q1 isn't necessarily a panic signal. Retailers have to buy immense amounts of inventory in the first half of the year to prepare for the back-to-school and holiday shopping seasons.
So the cash goes out early to generate revenue later.
Precisely. It's an investment cycle.
I understand the seasonality argument. You have to stock the shelves before the rush.
Right.
But if they are bleeding $319 million in cash just to maintain the business and build inventory while servicing $14.4 billion in debt, it raises a major competitive question for me.
The Walmart question.
Yes. The pre-earnings chatter in the research report heavily suggested Target is taking market share away from Walmart. How does a company with those fundamental cash dynamics outmaneuver the ultimate retail cash flow machine?
It's a great question, and it really comes down to understanding that Target and Walmart are fighting two completely different wars.
How so?
You do not beat Walmart on household staples. You just don't. You do not win a price war on paper, towels, milk, and basic groceries.
Right, Walmart's scale there is just impossible to beat.
Exactly. So Target's market share gains are happening in very specific discretionary categories. The sources highlight areas like beauty products, the Target Plus third-party marketplace, and consumer electronics like the Nintendo Switch.
Ah, yes, the famous Target-run psychology.
We've all been there.
Right. A consumer walks in intending to buy a tube of toothpaste and walks out with a $40 artisanal candle, and an oversized throw pillow, and a video game.
That is their moat. Target has engineered this highly curated, aesthetically pleasing environment that encourages impulse buying of higher-margin discretionary items.
And people fall for it every time.
They do. So when analysts talk about market share shifts, they are talking about capturing the disposable income of a middle-class consumer who might otherwise spend that money at, say, a specialty boutique or an online marketplace.
So that $1 billion in capital expenditure
is the price of admission to maintain that pristine, curated environment.
It is expensive to look chic.
Very expensive.
That clarifies the strategy a lot. We've established their strength in capturing discretionary spending, and we've exposed the asterisk of the tariff refund masking the operational profit. So let's look at how the stock market is digesting this mixed reality.
It's been pretty wild to watch.
Yeah, the stock closed at 152.48. It has soared over 45% in the past 52 weeks, and it is trading just 2.5% below its 52-week high of 156.47.
The market seems to be entirely focused on the headline and just ignoring the asterisk.
Right, the price action is undeniably bullish, and the technical indicators in the report support that momentum. The stock is trading well above its 20-day, 50-day, and 200-day moving averages.
Yeah, and to put that in perspective, the 200-day moving average, which represents the long-term trend of the stock, is sitting all the way down around $115.
Okay, wait. If the long-term average is 115 and the stock is trading at 152,
it means buyers have been relentlessly pushing the price up for months.
wow. The market has stretched the valuation incredibly far from its historical baseline.
They definitely have. And the report also mentions an RSI of 66.
Okay, for those not staring at stock charts all day, what does that indicate?
Sure, so RSI stands for Relative Strength Index. It measures the speed and magnitude of recent price changes on a scale from 0 to 100. It helps identify when a stock might be overbought or oversold.
So where does 66 fall on that scale?
Well, usually an RSI above 70 indicates a stock is overbought, meaning the price has risen so fast that it is due for a technical correction. At 66, Target's momentum is red hot, but it hasn't technically crossed into that extreme danger zone just yet.
I picture an over-engineered Jenga tower.
Oh, that's a good analogy.
Right. It is stacked incredibly high, the momentum of building it was thrilling, and technically it hasn't fallen over yet. But the center of gravity is completely distorted.
Yeah, one wrong move.
It requires perfect conditions to remain standing. Any slight breeze in the macro environment could send the whole thing crashing down.
A stock trading near its absolute peak, relying on one-time accounting events to justify its forward guidance, is the very definition of being priced for perfection. There is zero margin of safety here.
Which brings us to the fractured sentiment among Wall Street analysts, because they are not all on the same page.
Not at all.
Some are buying into the perfection. D.A. Davidson maintained a buy rating and even raised their price target to $170.
Yeah, they are extremely bullish.
But then you have major institutions like BMO and TD Cowen sitting firmly on hold ratings. Why the split?
Well, you have to understand the underlying psychology of a hold rating in equity research.
Okay, clue us in.
Analysts rely on corporate access. They need management to take their calls and answer their questions.
So they don't want to make them mad.
Exactly. So a hold rating is very often just a polite sell.
Ah, I see.
When a major retailer announces that profits doubled and the stock is up 45% over the year, you would normally see analysts rushing to upgrade the stock to a buy.
To ride the wave.
Right. So the fact that BMO and TD Cowen are stubbornly maintaining a hold rating is highly revealing.
They see the Jenga tower.
Yes, they do.
They are looking at the $1.65 tariff refund baked into the guidance. They see the stock sitting just 2.5% below its absolute ceiling, and they are concluding that every possible piece of good news is already squeezed into that current price of $152.
Exactly. They are signaling that the upside is completely exhausted and the downside risk is not being respected by the broader market.
So what are the specific pebbles that could knock this tower over?
There are a few big ones.
Right. If the stock requires flawless execution to maintain this 152 valuation, what is the actual bear case outlined in the research?
The bear case is centered squarely on macroeconomic headwinds that directly threaten Target's specific moat.
The discretionary spending moat.
Right. The report flags oil prices hovering above $90 a barrel, broader geopolitical tensions involving Iran, and structurally weak July retail sales data.
Let's unpack the oil thing. Let's connect the mechanics of global oil markets to a suburban Target store. How does $90 oil physically break their business model?
It comes right back to the Target run. Target survives on discretionary income, the money left over after the necessities are paid for.
Rent, groceries, gas.
Right. Energy costs act as a massive, unavoidable, regressive tax on the consumer. When gas jumps from $3 a gallon to $4.50, It instantly evaporates the exact pool of disposable income that funds the impulse purchase of a $40 candle or a new video game.
Because they still have to commute to work.
Exactly. High oil prices force the consumer to prioritize needs over wants. And like we said earlier, Walmart wins the battle of needs.
That is a direct, immediate threat to their margins. But there is another specific data point in the report that stands out to me regarding internal confidence.
The insider activity.
Yeah. The research notes that company insiders have recently executed 3 open market sales totaling 60,000 shares with 0 open market purchases.
Insider behavior is a crucial piece of the puzzle, especially at market tops.
I have to push back here a little bit, though.
Right.
Analysts often make a mountain out of a molehill with insider selling.
Fair. They do.
Right. Executives receive massive amounts of stock as compensation. They sell to pay taxes, to diversify their portfolios, to buy real estate. Across an entire C-suite and board of directors, selling 60,000 shares doesn't necessarily signal a mass evacuation. Isn't this just like routine financial planning?
You are entirely correct that insider selling in isolation is routine. Executives have expenses, they have to send kids to college.
Right.
But the critical data point is not the selling, it is the absolute absence of buying.
The 0 open market purchases.
Exactly.
Yeah.
0.
Yeah.
If you are an executive sitting in the C-suite and you have access to the daily sales dashboards, you know exactly how much of that Q2 earnings beat was driven by a government refund versus actual organic consumer demand.
You see the real numbers before anyone else.
Right. And if you genuinely believed the core business was accelerating organically into the holidays, you would view a stock price of 152 as a bargain.
You'd be loading up.
You would be buying.
Yep.
The fact that nobody on the inside is buying tells you they believe the stock is fully valued.
They are quietly cashing in their chips while retail investors read the headline and push the price higher.
Yep, it's a classic setup.
And this dynamic is going to be stress-tested almost immediately. The back-to-school season is a critical catalyst, followed quickly by the massive holiday inventory buildup.
Right, the pressure's on.
Ah.
And we also have a strategic wild card to consider here.
Oh, right, the board changes.
Yeah, the report notes that Joe DePinto recently joined Target's board of directors.
Why does adding a new board member matter right now? If the company just supposedly doubled its profits, why shake up the leadership?
Because board appointments are rarely accidental. When a company is operating at peak efficiency, the board remains static. Bringing in fresh external blood, especially someone with deep operational experience like DePinto, it often signals that management knows they have right. Their conclusion is that the positives, the market share gains against competitors, the headline earnings beat, the raised guidance, are already 100% priced into that $152 stock valuation.
The upside is cooked in.
Completely. However, the market is entirely ignoring the risks, the non-recurring nature of the tariff refunds, and the deterioration of the consumer's disposable income. Those factors are simply not reflected in the price.
The objective of this deep dive is not to provide financial advice or tell you whether to trade this specific stock. The goal is to provide you with the analytical tools to look past the bold print.
Exactly. You have to read the footnotes.
$1 of profit generated by selling more products to a returning customer is structurally, fundamentally different than $1 of profit generated by an accounting adjustment. Understanding that difference is how you evaluate the true health of a business.
It's really about developing an immunity to financial noise. Headlines are designed to generate an emotional reaction.
They want you to click, or they want you to buy.
Right. But real analysis requires looking at the cash flows and understanding the mechanisms driving the numbers.
Which leaves us with a much larger question to consider as you navigate the news this week. We've spent this time dissecting the micro-level mechanics of one company, but zoom out to the macro level.
Big picture.
Yeah. If one of the most sophisticated, successful retail engines in the American economy relies this heavily on a one-time government refund check to manufacture an earnings beat, what does that quietly signal to you about the actual underlying strength of the everyday consumer heading into the most important shopping season of the year?
It implies the foundation of the consumer economy might be significantly weaker than the market wants to admit.
The structural integrity is questionable. Keep looking for the asterisk.